Chair now recognizes the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman. I appreciate the opportunity to examine the impact of the Dodd-Frank law on its 4th anniversary. Chairman Frank, I appreciated your earlier testimony that your intention in crafting the mortgage reform provisions of the law were directed to encourage more risk retention. I have a bill, H.R. 2673, and that bill is a portfolio lending bill that would encourage more risk retention on the part of mortgage lenders, small banks like Mr. Wilson's bank. And in fact, not only was that bill marked up out of this committee, several of my colleagues on the other side of the aisle, including Mr. Perlmutter, voted in favor of that. And my question to you, would you support such a proposal to give a QM safe harbor status to portfolio loans in which the mortgage originator retains the risk?
I'd have to look at the specifics. I'm generally in favor of that, although I would like, and you said you would encourage this. I mean, I think we had to give in to the Senate and loosen the risk retention. I would like to have portfolio allowed to be whatever, as long as it's not below some certain objectionable level, but then also have stronger risk retention.
Well, I appreciate your general inclination toward risk retention and your general favorability towards that. Mr. Wilson, I want to direct your attention as a small community banker to the slide here. The ranking member earlier alluded to the fact that you should have no problem originating mortgages now because you're $2 billion or below in assets. This is a slide from the Consumer Financial Protection Bureau. This slide shows what is required, the chart, in order to qualify for the safe harbor protection. It's not just that you have to be $2 billion or below. It's loan features, it's balloon payment features, it's underwriting, it's points and fees. Then there's the portfolio provision. Does this slide explain why you and other community banks have exited the mortgage loan business?
The fact that it is so complex on its summary page here is part of the problem. But we did balloon mortgages, and so I don't know, I'd have to go through this.
Well, let me just cut to the chase. If we had a bill like the one that I was referring to earlier, where if you could portfolio your mortgage and hold it and retain the risk, hold it in portfolio, would you re-enter the mortgage lending business?
Yes, sir. I would love to be able to serve that segment.
Mr. Barr, could I ask you one question about that bill?
I have limited time. I'd love to talk to you after. Let's talk afterwards. Real quick, I want to just go really quickly to another point, and that is that Dodd-Frank was sold under the premise that if community banks played ball and had a seat at the table, they would be protected from its new regulatory regime, in particular jurisdiction under the CFPB. In fact, thanks to reporting in the Washington Post, we know that Chairman Frank had a strategy of selling Dodd-Frank as a bill that protected community banks because they would be exempt from supervision by the CFPB. In fact, the reporting says that according to Mr. Frank in communicating with the community bankers, said that there's going to be a bill. This is Mr. Frank talking to the community bankers according to the Washington Post. There's going to be a bill, and either you're going to have to get on the bus or be run over by it. I don't expect you to support the consumer agency, now the CFPB, in public, but what is it going to take to get you to be neutral? The community banker representative says, well, Mr. Chairman, that's going to take a lot. We don't want to have examination forces from this bureau coming into our banks, given all of the other regulators that are in our banks, and we only have 20 or 30 employees in each of these banks, and they're being eaten alive by exams. They jockeyed back and forth, settling on a standard. This is Chairman Frank and the community bankers. The CFPA is what they called it then. The CFPA's supervision would extend only to banks whose assets exceed $10 billion. And then, according to the Washington Post, again, Chairman Frank said, I'm not asking you to come out and support this, but will you stay silent? The community banker lobbyist says, I can make that work. We've got a deal. I reached across the desk and shook his hand. The Washington Post then reported that this deal was one of the most important made in the path to what would become, 9 months later, the law known as Dodd-Frank. Mr. Wilson, given that recounting of a critical deal made to get Dodd-Frank to the finish line, and given the regulatory maze that you have to go through in order to avoid these regulatory burdens, do you believe that Chairman Frank lived up to his end of the bargain in terms of exempting small community banks from the regulatory burdens?
Oh, we are subject to those regulations. We are not subject to examination by another agency. But when they make changes to the regulations, it changes my whole processes, and changes my training of my staff, and so it is very complex.
Time of the gentleman has